It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome, welcome. It is the Jill on Money show. We are broadcasting live from the Capital One Bank studios in New York. And we are saying goodbye to April, where I don't know about where you live, but here on the East Coast, it has been a very traditional April, filled with rotten weather. We're the flower part. April showers, May flowers. That's what we're looking for. Anyway, we are delighted that you are here. We are delighted that you are taking control of your financial life by tuning in and joining us. And remember, if you have a financial question, we always want to hear from you. And the easiest way to get in touch with us is to send us an email. Ask Jill at JillOnMoney.com. Ask Jill at JillOnMoney.com. And we'll do our best to get a hold of you and get you on the air. And if not, we'll try to throw in some emails, all of this. But, it is, I think, a really good time of year to take stock. Your taxes are done, hopefully, unless you're on extension. Now is a great time to kind of check in and see what's up. So that's a good thing to think about. Hurry up before the summer sucks you in. You know you're not doing this in the summer, right? I mean, we'll be here all summer long, but we just don't think you're going to want to do this in the summer. We start every show with a call, or at least we try to. And our first caller today is calling from Seattle. His name is Michael. Mike, welcome to the program. How are you?
Thanks, Jill. Great to talk to you. I appreciate the opportunity.
Of course. Tell me how I can help you out today.
Well, I have, both my wife and I have 401k plans we have with our employers, but also I rolled over a 401k from a prior employer, have about $800,000 in that. My wife has about the equal amount in hers, and she'll be retiring next year. We also have an investment account where we have about a million and some other investments, and we use a financial advisor for one part. We have another part in personal capital, which is a partial robo investment fund. And the fees of both the financial advisor and the personal capital will run, we're looking at about $25,000 a year.
Whoa.
And in fees for advisory fees. One gives charges 0.8 and one charges 1.2. I guess my question is, can we save money by just taking it all on ourselves and just working with EFTs and other investment vehicles ourselves and save that $25K?
Well, of course you can. Here, let's ask some more questions. So let's just go back for 1 second, make sure that I understand all the different pieces. So your wife currently has $800,000 in her retirement account. That's her active account. Then you said you've got a rollover. Is that with a broker?
It's with a financial advisor.
Right, and how much is the financial advisor charging? 1.2? And so what's at personal capital, the million?
Yes.
Okay, got it.
Yeah.
All right. Now, what else does the advisor do for you besides manage the $800,000 rollover?
Just looks at everything all together and looks at what puts in the Monte Carlo scenario things and gives us some nice looking pictures and tells us what we should have at certain points of time.
Mm-hmm. And has he run actual retirement scenarios for you? In other words, do you feel comfortable that you said your wife's thinking about retiring? I mean, do you feel at least in the advisor's estimation or in the way you've run your numbers that this $2.6 million is sufficient for your retirement needs?
Yes.
Okay, great. That's fabulous. That's really the most important part here. So it sounds more like the advisor is doing just classic money management, as you said, with nicer charts probably than you and I could create, right? So
Right.
I mean, hey, kudos to those charts. But sometimes an advisor can be incredibly helpful when you are facing these transitions. But if this person isn't actually doing that and really kind of hasn't rolled out a good playbook for you, then I think you are very smart to reconsider what your options are. So let's talk about this. Let's say that you took. I'm going to pretend the 2.6 million is now available to you. How do you feel about managing that yourself?
Well, with the good advice of the internet, I think it's possible to do an okay job.
Mm-hmm.
Getting 4 to 8% returns.
Right, even 4 to 5. You don't need to do 4. You don't need 8. You need 4 or 5. That's all you're going to need. You don't need it. Okay, so basic choices. It's funny about personal capital because I think they're a little expensive for what they do. So let's say that you took the 2.6 million, and here is what the choices are. I do it myself, and you can either use exchange traded funds, but you could use just low cost index funds. You don't even have to do an ETF. You could literally just say, I'm going to put this entire $2.6 million. So it would then be your rollover, your wife's rollover, and then the investment account. You can take all of that money and go to Vanguard, Fidelity, T. Rowe Price. You could go to Charles Schwab, TD Ameritrade. You could do it. You could literally do that yourself, and you'll get yourself an allocation, and you won't be too crazy. And I think that that's something that is perfectly reasonable, and it will cost you, even if you chose some more esoteric indexes, we're talking about, I don't know, 10 to 20 basis points, 0.1 to 0.2% annually versus, as you know, let's call it about 1%, because I'm sure that if the advisor got all the money, they would probably drop the fee down to 1%. So what's the difference? The difference is that 1%, as you say, the 25 grand falls to you. Now, if you wanted a tiny bit more help, then what you could do is you could go to a robo that has more advice. And that would be a place like Betterment, which now has advice. It's Vanguard that now has advice. I believe Schwab just rolled out a new model that has advice. And that would cost a little bit more, but maybe it would be like 1/4 to 1/3% a year. And maybe that's the idea here, is that you try that first, look at the allocation, see how that goes, and then if you want to take the whole thing on yourself, you could. So hang on one second. I want to go to a quick break. We're going to come back to you, and I just want to get your feeling about that. I want to hear your reaction to those different scenarios. So hang on, Mike, because when we come back, we'll be able to chat with you a little bit more. And gang, you always have choices, but those choices come at different costs, right? And all we're trying to do is weigh what those costs might be. So if you've got a question just like this, give us a holler. Ask Jill at JillOnMoney.com. During the break, hop onto the website, JillOnMoney.com. Sign up for our free weekly newsletter. Okay, we'll be right back with the rest of our answer to Mike.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money. Have you read my new book yet? Do you own it? If you don't, just go to the website, JillOnMoney.com. Click on the link that says the book. You can get it from lots of different booksellers. Love you to read The Dumb Things Smart People Do with Their Money. All right, before we went to the break, we were talking to Mike in Seattle. And Mike, first of all, I forgot to give the big lead, which is you and your wife have done an amazing job at saving for retirement. So kudos to you.
Thank you.
You had to take a moment. We're going to let you take that moment. So we outlined the choices that you have in front of you. I mean, obviously, you could consolidate all of this money send it on over to the advisor. And I would even venture to say at more than $2 million total as a relationship, the advisor might drop the fee down to even, I don't know, 0.75% or 0.8%, something like that is my guess.
Mm-hmm.
And so then the differential isn't as big. But again, if someone is just managing money versus really feeling like your overall financial coach mentor, then I think you have a different choice. And so I guess I'm wondering from you how you feel about the choices of either just doing it yourself with no load mutual funds that are index funds or exchange traded funds. Then the middle option being going to a robo that's cheaper and also might have a financial advice component. And the third being consolidating everything with the advisor and trying to negotiate the fee down. So the difference being, let's call it about 0.8% for full service, 0.25 or 0.3 for a robo with some advice, and probably 0.1%, 0.1 for just doing it yourself. Which one sounds appealing to you at this point?
Well, I think that, if you look at it, the percentage of management costs, it probably runs it down to about $12,000 a year if I put everything in one bucket.
Right.
So, that is not as unpalatable as $25K. So having somebody else take a look at that and managing like tax loss harvesting or taxes side of things, it may be worth it for my comfort, since I'm not a whiz at it, to have somebody else keep an eye on that if I can get the percentage down to like 0.6 or something in that neighborhood.
Right. And I think that it's worth, do you like the person who's managing your money right now? That's the other question.
Like them well enough.
That doesn't sound like a ringing endorsement to me, my man. Okay, let's be clear. You should talk to him anyway and just say, I'd like to talk to you about really, the nature of our relationship and say that you can even say like, I am considering consolidating everything, but I just want you to know I'm putting this out to bid. That's what you should say to him. And say,
that's a good idea.
Right? I'm putting it out to bid. This is my shot at coming back and saying to him, because, look, the guy's probably he doesn't sound like he's like a horrible person or anything. You want to give him a shot. And you say, I'm going to put this out to bid. I've been satisfied, but not overwhelmed by what, where we stand with you. I am seeking some more retirement advice and really a strategy about how you would say I should handle the next year before my wife retires. And then when you ultimately retire, also want to know what your game plan would be to create income from this portfolio so I can leave my retirement accounts alone for a long time and just live off of the non-retirement investment account. I want you basically work for your money, darn it. And so see what he comes back with. At the same time, I also might talk to some other folks in your area. I might go and interview a NAPFA advisor, a National Association of Personal Financial Advisors, NAPFA. You may want to go talk to somebody who is maybe a flat fee advisor. Maybe you say to someone, I got $2.6 million and I would like to, I want to pay you $10,000 to give me a kick-ass retirement plan and asset allocation plan that I can put into place. And maybe and it could be a one-time only thing. And then you should start looking at these different robos that have an advice component and see what you think about those. And let me know what you come up with. A lot of this is just about your comfort level. That's why I said, how do you feel about it? I have to believe that if you could get yourself to about, as you said, 50 or 60 basis points with a real advisor, not someone who's just managing money, that could really be worth it, especially for the first few years of retirement, where you're making a lot of these key decisions. I think that's the way to do it. And it's a good moment to just to check in with this advisor. I wonder, I'm really going to be interested to hear what his reaction is going to be. Because if he's a class act, he'll just take this in stride and be like, you know what? You're right. I want to get, I'm going to do better for you. But if he's kind of a jerk, he might be like, tough luck. Our fee is this. and screw you. I mean, you know, he won't say that, but you'll get that feeling. And that's going to be instructive as to whether or not you stay there.
Yeah, and I think he'll go the other way.
Yeah.
With that, and that's really good advice.
All right. Well, other than that,
Appreciate
you got your estate documents managed? You got that handled?
I do. I read your book and recommended it to everyone. So I'm tasked with that. So
well, Mike, you are
book.
fantastic. Thank you so much. Thank you so much for calling, and let us know how it turns out. I'll be really intrigued to hear what happens in all of this and what your decision is. So I want to hear back from you. Okay.
Very much appreciate your help.
All right. Take care. Thanks. Oh, man, I think that's really good. Interesting. Think about this. When you are at a transition in your life, this may be a time when you reevaluate your relationships with your advisor. And it could be a time also where you say, what exactly have I been paying this person to do? What am I getting out of this? And it could be that when you drill down and talk about it, maybe Mike's going to go back to the advisor, and the advisor is going to be really a good person and say, almost own it and say, yeah, I think I got to do better for you. We'll see. But there are so many choices now, so many opportunities, that I think this is the true test of whether an advisor is worth his or her fee. And that is not just doing money management. Because as we talked through this, we really learned that money management is a commodity right now. You can manage your own money for 0.1% a year. You can hire a robo-advisor with some help, by the way. And you know what they are. They're out there. 0.25% a year. Maybe it's Betterment. Maybe it's Vanguard. Maybe it's the Schwab service that they just launched. These are unbelievable opportunities to get some advice, and it may not be a dedicated person. I get that. And also money management. And then you're at the point where you say, well, what would I be willing to pay for a full-service, dedicated advisor who can walk me through this? And in Mike's case, I think that the idea of 1% is not cutting it, right? He doesn't want to pay $25,000 a year, $26,000 a year for that. But would he pay half of that? Maybe he would. That's what he just said. Maybe if it's $12,000 a year, maybe I would be okay with that. Let's see what the advisor says. Mark, what do you think he's going to pick? What do you think the of the three, do it himself, robo with some advice, full service advice for a lower fee? What do you think he's going for? Mark thinks he's going to go for 3. All right. I'm intrigued. I'm totally intrigued. I would I really got to say, I'm going to be really intrigued as to what the outcome is going to be. All right. If you have a financial question, I would love to hear from you. And so would Mark. Send us an email. Ask Jill at jillonmoney.com. And hey, check out our podcast. You can get it on Apple, Stitcher, radio.com, Google Play, anywhere else you find your favorite podcasts. Coincidentally, the name of the podcast is Jill on Money. Okay, we'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back with Jill on Money. Mark has me chained to this desk. Won't let me out of the studio. How long have we been here now? 5 hours. 5 hours with a few television hits in between. Maybe when we create our own studio, whenever that is. What's going on in your apartment? Maybe we'll put the studio in with the kid, right? No big problem. I'll come down to your apartment, be like, get me down off the Upper West Side. All right, let's see. We do have to get to your questions, and thank you so much for all of you who have written in. Our email address is askjill@jillonmoney.com. And if you're on the website poking around, maybe you are reading some previous blog posts, maybe you are listening to old shows, maybe you're watching some videos, maybe you are buying the book, The Dumb Things Smart People Do With Their Money. If you're there and you've got a question, something kind of creeps into your mind, all you have to do is click the Contact Us button. Okay, Helen writes that she will turn 70 at the end of the year. She's got $500,000 inside of a retirement account and wants to move it into an IRA, then pay the tax that's due and roll it into a Roth. And then she would do it sort of halvesies. So she would, I guess, move it out half in 2019, half in 2020 before I'm 71 and a half. Can I do that? If it's an IRA, can I roll it over into a Roth over time, or must it all be done before I'm 70 and one half? Right now, between my house taxes and minimum required distribution, I'll be paying over $1,000 a month as a widow. I can't afford that. There seems like a lot going on here, huh, Mark? I mean, you can do it. I don't know if you should do it, because I don't know if you, I mean, it doesn't seem to me, it doesn't seem to me that this is necessarily the best decision for you. I can't, I don't quite understand why you feel like you have to convert it. What's the motivation there? Because you can take your required minimum distributions and so what? I mean, you're going to pay the tax one way or the other. I just don't know why you're going to pay it all at once. And I don't know if you have the money to pay for the taxes outside of the account. If you do, that's one thing. If you don't, then you can't do this. I need more information, Helen. I really do. Okay? So don't do anything yet. Jim says he may be leaving his company for another one. He needs to know what to do with his pre-tax 401k. He's got about $222,000. He's got 401k in equity funds. He's got another fund. So why not a couple things. The pre-tax 401k, can you move it into your new company's plan? That's the most efficient thing to do. So I think that would be, to me, the best thing. If you can't do it immediately, you may leave the money in the old plan and then wait until you can roll it all into the new plan. Well, it might be kind of a good thing. And I guess the alternative would be you could roll it into an IRA rollover where you could put that anywhere you want. Any investment company or robo-advisor, anything. But sometimes it's just easier to keep it as from one 401k to another. So let's find out what your new 401k is going to look like. That would be so. And for a lot of plans, by the way, you could just leave the money there indefinitely. Many plans just allow you to stick around. Don't discount that as an option. Teresa's dad recently passed away. It stinks. Left mom with about $500,000, $400,000 in CDs. His lawyer who handled the probate suggested she open an irrevocable trust. She has enough monthly income to cover her expenses. She's very nervous about doing the trust. I don't know why you need an irrevocable trust. Is that because they want to put that money over into a trust so that she could potentially qualify for Medicaid if she needed nursing care? The problem with putting it into an irrevocable trust, the reason why your mom probably feels nervous, is that you can't really touch the money. It's tied up, and she loses control over those assets. I need to know more about if she has any other money. That would be kind of interesting. Because if this is all the money she has in the world, I don't know if she really needs to do this. There's a lack of control and with an irrevocable trust, so you just have to be careful for that. So I need a little more info. This is the segment of info. We need more info. Judy wants to know about the state university retirement system in Illinois. The question is, I had the opportunity to pull out my money and call it a day with the state, but I think I might receive more money if I took the pension. With all the talk about the pension system in Illinois and deficits, I need someone else's opinion. Yeah, Mark's just hopped on the line. He said to me, cash out. Illinois has a rough state of finances right now, and I know you probably could have more money, but I might take the money out and play it safe and forego that extra amount. I don't think that it's going to be. I don't think that that's worth the risk. I just don't. So I hope that helps. Yeah. Okay. How much time, man? 1 minute? Can I do this fast? John says his daughter, she can get a 403B in her school system. My immediate reaction is good idea. If you've got one, what investment vehicles? Depends what her choices are. Send us her 403B choices. She's got a credit card in her name, 30 grand. Problem is her husband charges on the car. He makes payments against the card. The total never goes down. She was putting her savings together, get it to 15 and cap it. Her husband doesn't want to cap it. It would look bad. She works in the school system. Okay. Don't put money in this 403B just yet. I want to know what the choices are, because maybe it's better if she just does a Roth IRA. Second thing about these kids, get a handle on this credit card debt. And yes, if you can, I wouldn't put all the savings down because I don't want her to get rid of all the emergency reserve fund, but she got to get this. She and her husband got to get some religion on this and make a change here. Okay. It's Jill on Money. Give us a holler. Ask Jill at JillOnMoney.com. We'll be right back.
If you've missed any part of the show or want to check out a past show, go to JillOnMoney.com for more great personal finance content.
You're back with Jill on Money. If you've got a financial question, we'd love to hear from you. Our email address is askjill at JillOnMoney.com. And don't forget, we are looking for some help. We are creating the Jill on Money Financial Glossary. And to do so, we would like to know which words or financial terms you would like us to define. Send us that request, and we will oblige. We're building it, so don't get crazy. It's not going to be comprehensive. It's going to be over time. We know full-time staff here, you know. So send us an email, askjill at JillOnMoney.com. We're going to add it to the resource section of the website, JillOnMoney.com. So you can bookmark it and then look stuff up when you need to. Sound good? Good. Excellent. We are going to answer some questions. We are very busy plowing through the emails. And here we have from Doug, who is an employee with about $233,000 in his 401k. And the 401k is held at Vanguard. And he said that for 401k participants, there is a charge of 0.4% for investment management. Is it a good deal? And is it tax deductible? Easy thing first. Is it tax deductible? No, absolutely not. Because no longer are your investment management fees deductible, even if you itemize. Is it a good deal? Well, it depends. And here's what I mean by that. If you are just looking to throw this on autopilot, the question really is, could you simply put a allocation into your 401k and have it just update automatically or rebalance? And if that's the case, then you don't need to pay them. But if you are, maybe there's two reasons why I would really look at this kind of a plan. One is maybe when you retire, you don't want to have to deal with it. You get access to a financial planner, and that can be a good deal. But if this is just investment management, I just think, Doug, that you probably don't really need this. We can help you with your allocation if you want to follow up with us. So let's try that. Okay, Kent says his wife is retired. He's got 5 more years until his retirement. She's 59. He's 58. They don't have kids. And he says, I think we're going to have enough money for our retirement, $1.4 million, if we have a simple lifestyle. So here's the issue. I want to keep what we have and avoid paying 1.5% annually to our financial planner. Can you suggest a low-cost, no-risk investment mix that we can manage ourselves? So here's a great example. So here's Kent, who's asking this question. This is a great example where you might want to choose a robo-advisor. And I think that Kent's question may be interesting in that the charge might be 0.3% at Vanguard. And you can also choose to go to another investment platform. You might be able to go to, say, Betterment. They used to be the sponsor of our podcast, and you pay 0.25%. Or you can just do it yourself. You can go to index funds, which are basically going to cost you less than 0.1%, and put together an allocation that's kind of a simple allocation. You know, little stocks, a little bonds, a little cash, a little international, and maybe you want to be 50-50. 50% safe stuff, 50% more aggressive stuff. So I think that's really what I would say is a good low cost. But you ask for a low cost, no risk investment mix. Guess what? Everything has risk. That's really important. That's really important. Final question from Kent. How do we start taking or arranging for distributions from our retirement account? You can actually set that up wherever the money will end up being held. They can send you the money that you need. They can do it on a monthly basis. They can do it annually. And all you need to make sure is, when you're managing this yourself, is to leave enough money in cash to make those distributions. Okay? Jill writes, not me, Jill. I was wondering why you recommend putting money into a Roth than a long-term CD. Both are for post-tax money. What's the advantage of a Roth over just a savings account? Well, the difference is that a long-term CD, the interest that you get is taxable. And in a Roth, it's not. And if you're using a Roth for retirement and you wait until you're 59 and a half, when you pull the money out, there's no tax due at all. So the advantage is it's all about taxes. And that's why a Roth is so fabulous. I do love that. Really. Okay. Mark just keeps sending me more and more emails. Okay, let me see here. My uncle is in charge. This is from Michelle. My uncle's in charge of my mom's money. She gave each child $10,000 each. My uncle told us we have to give it back when she goes into a nursing home. All 7 promised our dad at his deathbed we will not put our mom in a nursing home. Do we have to give it all back? We have more money coming from our mom after she passes. Well, you don't have to give it back. There's no, unless there was some sort of legal document. This is going to be nasty, though. I wonder who holds the healthcare proxy. That would be very important to understand. Okay? So somebody has that document, hopefully, that will outline what the person's wishes are. And if not, that needs to happen. So time to have a conversation with your siblings and have a discussion about it. Okay? We're done. Okay. Mark's giving me the, let's move it on. All right. When we get back, we're going to have a question about a safe deposit box, which safe deposit box just aren't in vogue anymore. You know? We're going to talk about it. It's Jill on Money. Go to the website, jillonmoney.com during the break. And while you're there, why don't you buy the new book, The Dumb Things Smart People Do With Their Money, 13 Ways to Right Your Financial Wrongs. I had so much fun promoting this, and I will continue to do so forever. Okay, we'll be right back. You're back with Jill on Money. And we are broadcasting live from the Capital One Bank studios here in New York. This is an interesting question that we got from Donald, who, interesting, his mom had a bank account, and associated with that bank account, there was a safe deposit box. And Donald said that he was the secondary account holder. And this dates back probably decades. He said, then the bank was shut down. The bank was called the Central Bank for Savings in Meridian, Connecticut. Now, his mom is in assisted living, dementia stage 3 dementia. She, of course, has no idea where the box and its contents are. And so the question is, can you point me to someone that might be able to assist me? What can I do? Okay. He says he feels like he's going to lose the bonds and doubly savings bonds and all this stuff. So here's what I did. I went to the state of Connecticut, portal.ct.gov, and I went to bank information. And what it looks to me like is, yes, you're right. They closed Meridian Trust in 1994, July 1994. But here's what happened. They sold the operation. The FDIC shut it down and then sold the operations to People's Savings Bank of New Britain. So that's your best bet. Go to the People's Savings Bank of New Britain and track down that safe deposit box. I mean, I'm sure it's still there. It's just a question of how you're going to get it. This is one of the problems with safe deposit box. But I just want to tell you, be diligent. Look for it. I think you can get it. Nick wants to know about 401k investments. He said, I want some safety. I want to make some good money help. Options, large, mid, small cap, real estate. That's it. That's all I remember. Okay. Nick, listen, send us a list of the account of what's available, and then we'll help you out because we do not want to, we absolutely positively want to make sure we give you the best options that are available to you. All right, that is it for hour number 1. So exciting. If you missed any part of this show, you can always listen to it on the website, JillOnMoney.com. Also on our website, you can subscribe to our podcast. You can get it on the website, or you can go to Apple, Stitcher, Radio.com, Google Play, anywhere else you find your favorite podcasts. Okay, we will be back. More of your questions in the next hour. Stay tuned.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
You're back. It's hour number 2 of Jill on Money. We are broadcasting live from the Policy Genius Studios here in New York. Policy Genius is the easy way to compare and buy insurance. And it is easy, so check it out. PolicyGenius.com. All right, if you've got a financial question, we really would love to hear from you. All you have to do is send us an email, askjill@jillonmoney.com, or alternatively, if you're on the website, jillonmoney.com, click the Contact Us Here button. Here's someone who actually responded to our free weekly newsletter. And her name is Linda. But if you wanted to actually sign up for our free weekly newsletter with all sorts of chock full of interesting information, all you have to do is to go to jillonmoney.com. I think as soon as you go there, you're asked to sign up for that newsletter. Isn't that so? Mark has it all set up. Linda wants to know, how do I report that I've donated my required minimum distribution as a qualified charitable distribution on my tax return? I've been issued a 1099-R for the distribution. It doesn't indicate that it was a QCD. So here's what I did. I went to the IRS website, irs.gov. And this is what it says. To report a qualified charitable distribution on your Form 1040, you report the full amount of the charitable distribution on the line for IRA distributions. On the line for the taxable amount, enter 0 if the full amount was a qualified charitable distribution. Enter QCD next to this line. And also you have to file Form 8606, non-deductible IRAs, if you made the qualified charitable distribution from a traditional IRA in which you had a basis and received a distribution from the IRA during the same year. Or the distribution was made from a Roth IRA, although why would you make that from a Roth IRA? I don't know. Roth IRAs are not subject to the required minimum distribution. So there it is. Easy. Go for it, Linda. So much. If you really want to know where your tax dollars are put to good use, go check out irs.gov. It's fantastic, actually. John writes, a new financial advisor that I may select to manage my investments wants me to sign a limited power of attorney agreement. What steps should I take to protect myself against misconduct? I have no reason to suspect, but I have no experience with him except 2 meetings. And the advisor I wish to do business with is a member of the Schwab Advisor Network. I guess, is the reason, I mean, first of all, the question is, why does he need a limited power of attorney? Is this so that he can trade on your behalf? If that's the case, not sure that you need to do that. But you might, and if it's just because you're giving him discretion, seems fine to me. That would be my general. I think that's sort of the general progression rather. And if he doesn't have, I guess there's no reason that you would sign a limited power of attorney if he were not on discretion. So a discretionary person probably needs that. But you can always check in with Schwab about it, you know. Okay, this is anonymous. I'm a 71-year-old widow and have managed my money conservatively. My late husband also managed the money conservative. Okay, my pension and Social Security, $121,000 a year. I've got $550,000 in a Roth, 4 mortgage-free rentals, 4, ladies and gentlemen, worth about $650,000, and a personal residence worth just about $1 million. There's a $250,000 mortgage. Should I start gifting my 2 children my properties or sell rentals and gift them money? Should I put the properties in a revocable trust for them to get stepped-up value upon my death? Well, first of all, I think you should talk to an attorney. And no, you should not be giving anything to your kids. Do not give any residence or gifting anything. Why? Why would you do that? Definitely no. That said, I think you should talk to an attorney and figure out whether you actually need a revocable trust. What are we trying to do here? If you needed to go into a nursing home, you have $121,000 a year. I'm not sure why you want to start gifting the kids so much money, and I'm not sure if that makes sense for you, but go see a qualified estate attorney, okay? That's very much more important than anything else, okay? All right, here we go. This is from Joel. Okay. I enjoy your show, and I think I'm sending you a question you have not received before. I overpaid my taxes. My state taxes by a total of $1,000 in 2009 and 2010. But I didn't discover it until July 2018 and pursued a refund. And the State Department of Revenue responded they were sorry, but their statute of limitations prevents them from returning my overpayment. I contend the state employee who processed my return didn't catch my mistake. They responded that the Department of Revenue don't have personal responsibility. My error, I believe, resulted from a faulty TurboTax calculation of my pension. And what are your suggestions? I don't know. This one's tough. I guess that I might go, since you've already pursued the state, I don't know if they're going to be able to do anything. I mean, I think they've sort of given you the answer to your question. I guess you could go to like your state Department of Financial Services, whatever that is, and try to pursue it that way. But it sounds like they're kind of holding firm. Ah, boy. Harvey wants advice about how to get out of a timeshare. He says, I realize from what little I've read that I shouldn't expect any money back. I'm nervous about being taken to the cleaners by a company that's not reputable. I looked on the Better Business Bureau website, noted some recommendations. Do you think these companies are okay? What price would I be expected to pay? I'd love to talk to you. Any info would be helpful. I would go back to the company that actually, yeah, you can do it. I don't know a lot about the timeshare business. I know that it's, to quote my mother-in-law, timeshares are for suckers, is what she said. But you might find some luck in going to the company and trying to sell it back to them directly. That's a possibility. But I still think that you're just not going to get a lot of money back. So, okay. Dennis writes, I'm tired of fees with no results. I've got 130 grand in an IRA. I'm 64. What can I do to avoid fees? Poor results I'm not going to talk to. To avoid fees, you're going to try some sort of robo-advisor. And that could be a Vanguard has one, personal services for about 0.3%. Betterment, former sponsor of my podcast, 0.25%. Or you can just open up an account at a no-load index fund company like Vanguard, T. Rowe Price. You can go to Fidelity, Schwab, any of these places, and put half the money in a stock index fund and half the money in a bond index fund. Good luck, Dennis. All right. During the break, why don't you go to JillOnMoney.com, and there you can peruse through all the fun stuff that we have. You can read, listen, watch, and again, you can sign up for that free weekly newsletter. We'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back with Jill on Money. If you've got a financial question, we'd love to hear from you. Our email address is askjill@jillonmoney.com. Our website is jillonmoney.com, and there we are trying to build a financial glossary. So if you've got a term or a word that you come across all the time and it just nags at you. Sometimes that happens to me with how to pronounce a certain word that I've read a million times, but then I have to say it out loud. So I go to the YouTube to see. I always want to use some sort of, some article like the Facebook. Kathy writes that her husband passed away a year and a half ago, and she hasn't done anything with the $600,000 or $600, Mark. What do you think? I'm guessing it's $600,000 that she received in life insurance proceeds. She goes, I don't know who to trust. I think I would like to put it somewhere I could earn about 5%, take out the interest every year, and live on other funds I have available, pension, savings, Social Security. Is there a safe place to put these funds? I do not like market volatility if I don't have to be involved in it. Preserving the principal would be my goal. I don't think you're getting 5%. Let me just start there. But let's say that you wanted to try to build something like what we would call a CD ladder. And that really would require that you put some of the money in for a 1 year, a 2 year, 3 year, 4 year, 5 year, 6 year CD. And you can go to depositaccounts.com and you can look at with the CDs. So if you go to a longer term CD, say a 6 year CD, you can get over 3%. And then it'll kind of squish back down to, down to the 1 year CD rates, which are more like 2.5, 2 change. But you're looking at about 3%. So I don't think you're going to get 5%. The way that you could potentially try to earn 5% is that you could take a bunch of the money and put it in CDs, and then you can put some of the other money and just maybe throw it into an investment account where you've got some safe stuff like just maybe a money market account, and then a little bit in securities. But that's, unfortunately, right now, just given where we are in the interest rate environment, Kathy, you don't really get that kind of juiced up 5% that you'd like. So give that a whirl. Let us know if you need more help. Walt writes that he and his wife are both 56. She's worked for a company for 20 years. She's got a pension and has approximately $500,000 in a retirement account. It's invested with Fidelity. I am self-employed, and I have approximately $39,000 in a Roth. I make too much to contribute to it any longer, and then I've got about $400,000 that's liquid, and I'm looking to invest that for retirement. We're planning on retiring in about 10 years. Their primary residence, got a mortgage on it, a couple rental properties, and he says all my rental properties are going to be paid off in 7 years. My primary will be paid off in 9 years. what should I do with this $400,000 that's liquid at this time? Well, look, I mean, you could sort of go by what your wife has in her retirement account and look at the Fidelity investments that you've chosen, and hopefully you've picked an allocation that kind of matches what your risk tolerance is. I might look to that as a guide. And if just to make it easy, you may want to just open the account directly at Fidelity. Otherwise, you can go into a online investing platform. And we've talked a lot about this show, but one of these that just sort of does it for you. You go through a risk questionnaire. And I think that Fidelity probably has something like this. But if not, Vanguard has one, Betterment, Wealthfront. And go through that and try to select a allocation that you can stick with. And, I don't know what the allocation is going to be because it really depends on more of your financial life. But that's what I would be looking to do. Okay? That's funny. There's a quick follow-up that I just realized that came in. There's another email that came in from Kathy, who's the question before this one, about the money, the life insurance proceeds. She says that her insurance agent says he can guarantee 4%, which I'm guessing is that he wants to buy some sort of annuity. So no, don't do anything with the insurance agent. You don't need that. Okay? Just do it yourself, or go get yourself a financial planner. Okay? That's a good thing to do. Here's the other end of the spectrum. A 29-year-old named Matt. He's maxing out his 401k and his Roth IRA and his HSA. Debt student loans will be paid off in a year. Mortgage has $315,000 left. That's my next target. I make $100,000 a year. I want to decrease my tax exposure. Where else can I put my money? Life insurance? No life insurance. Why do you want to get? I don't see why you want to pay off your mortgage unless your mortgage interest rate is really high. I wouldn't do that. You're doing everything you should be doing, Matt. Your tax exposure. I don't know why you shouldn't have such a huge tax exposure on $100,000 of income. I would open a. I mean, you're doing the Roth IRA, which is great. And you keep doing that. But I think that at this point, you start a non-retirement investing account and you make sure you don't buy big tax-generating assets that are in there. Okay? Wanda is a dedicated WCCO radio listener. WCCO in the Twin Cities. And she says, we apparently did a terrible job of educating our youngest daughter about all things financial, and I don't see a way out of a near mess. I'm hoping to get my grandson off to a better start. I don't want him following in his mother's footsteps. Can you recommend any online workbook-based financial program that works? You know what? Go get my friend's book, Worth It or Not Worth It. Isn't that what Jack Otter's book is called, Mark? Worth It, Not Worth It. That's a great starting book. You can also try, what about Aaron Lowry's first book, which is called Broke Millennial. Try Broke Millennial. That's another one. That's a good one to try. There's a couple of good sources for you. All right. Here is a question from Agnes. I'm building a house in a few months. In lieu of maxing out my solo 401k, would it make sense to shift that money to the cost of the house if the need arises? I've got enough cash to get through about 3/4 to 85% of the house building costs. For the remainder, I could take a loan if my if my normal workflow cash flow can cover it. But I wonder if it'd make more sense to divert the retirement contributions that I would have made for about a year or two for the finishing of the costs. I've been maxing out my retirement contributions for 10 years. And according to retirement calculators, I'm a little ahead of where I should be in my savings. What do you think, Mark? I'm thinking it's okay for Agnes to do that. I mean, I know I generally don't like that, but I think that there's a certain amount of risk of you waiting to see whether your cash flow can actually absorb this. So I think that I would probably make that decision. Craig listens to the program on WBEN in Buffalo, and so I heard part of your program about Social Security survivors. My dad passed away 10 years ago. My mother's only been collecting her small share of Social Security. Does she have some claim to his, which would be much larger? She should check with the Social Security Administration. Yeah, That's absolutely. Unfortunately, you can't go back in time. You're not going to be able to go get what you should have gotten, but I would contact the Social Security Administration pronto and see what you can do with that. Okay? Hey, Mark, how about that? All through those, right through all those emails, my friend. Not bad, right? I know you want to just do more and more. We're trying desperately to catch up and dig out. But we've done a very good job, especially considering that we got a ton of emails about the book and all those appearances I did for the book and a ton of emails about tax season. So I'm very grateful for all of you who write in. Please be patient. We do try to get to every single email and answer your questions as quickly as we can. They do sometimes pile up. You are listening to Jill on Money. And if you do have a financial question, give us a call. No, don't give us a call. Give us a shout. How about that? Drop us a line. Ask Jill at JillOnMoney.com. We'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back with Jill on Money. If you have a financial question, we totally would love to hear from you. Okay? Just give us a holler. Our email address is askjill@jillonmoney.com. Okay, so this is interesting. I'm looking here at an email from somebody, and they've sent me the name of a new company. And so basically, here's the deal. They have one advisor, and the advisor they've had for a while, they've liked, but the problem is that the person they're dealing with has gone to a new firm, and it's called Advice Period. Have you heard of this, Mark? I haven't either. So they think that they really like the So here's a critical question. We're comfortable with the current firm, but the person they dealt with at the old firm moved to this place called Advice Period. So I went onto this website, and it's kind of interesting. Let's check out these people. Let's maybe find if we can get like their CEO on the air. So this is called Advice Period, and it says we put our clients first. Okay, and they are fiduciaries, so that's good. And we're gonna click. I'm gonna click on this button just to poke around and say, like, hey, what's different? This is basically that their fees look like. What are they getting for their fees? Getting rid, if you haven't asked your client advisor, the fees you pay. I don't know what fees they charge. How about that? They got a nice website. I don't know. I mean, look, I think that here's what I would do. I would look at the current advisor, look at the fee you're being charged there, and talk to your new person and find out, your person who used to service you at that firm, and then say, hey, what are the fees with the new firm? And also find out from the person who you used to deal with, what's the difference between the way they manage money? So that's what I would do. And I hope that that's helpful. I think that that's kind of the only choice you have, because otherwise, I don't know, you're sort of in this weird place where you are trying to figure out like the difference between the two without asking. So let's just ask. All right. This is from Jean, who is single and works full time. She makes about $130,000, $140,000. She contributes the max with a catch-up option into her employer's 401k. And the question is, can I contribute to a Roth given my income level? Well, let's look at that. Retirement plan contributions to a Roth are phased out for 2019 for single folks at $122,000. You said you make $130,000 to $140,000, but you say that you're putting away the max right now into your 401k. I think you can do it. It's close. So if you're putting away $19,000 plus the catch-up, that's your $25,000. Then essentially you've dropped your. Let's say she makes $140,000. You're right. I think you could do it. I think you should be able to do it. You might want to wait until towards the end of the calendar year just to see whether or not you go higher than you think. That way you don't have to recharacterize your Roth. That's what I would do. Definitely. Okay. Here's a note from Karen. The subject is living trusts. My husband's 67. I'm 68. We're retired. We own a farm in Minnesota, 40 acres. The estimated market value, $125,000. They've got their wills, they've got a power of attorney, they got healthcare directives. Great. We've also heard about living trusts. We're considering that. One lawyer I called said people don't do that anymore. The reason why he said that, or she said that is that the estate tax rules changed pretty dramatically. And so maybe you don't need that to avoid estate taxes. However, let's see what the next sentence is. Our financial advisor referred us to a lawyer who said he would help us with the trust. He's given us questions to go over with our kids. The trust will be in their names. Then we all met with him. Our concern is that we mentioned that we want to put a large shed on our property as the outbuildings need replacement. He said it wouldn't be a good idea to keep gifting to our kids. There's remodeling. I don't understand how it all works. The big question is, we are wondering if a living trust is a good way for us to plan for our estate. I don't know. It seems like a little bit unnecessary. I'm not sure, but I'm guessing, given the situation, that maybe you're a little young. Maybe what's being suggested to you is that you're gifting a little too aggressively, given your age. And the reason why you would use a trust at this point is to have better control over the assets. So maybe with the kids, you don't trust the spouses, or you want things to kind of flow in a very specific way. I don't know if you need it. Doesn't sound like it. But I'm not a lawyer. Okay, Joseph has a fiance. They're getting married in July. They've already combined their finances. They've got minimal debt, home mortgage, 2 car loans, and her student loans. Okay. They're 32 and 28 years old, respectively. They've got about $1,500 left after groceries and other bills every month. Okay. So what do we do with that money? Pay down debt, invest, add to savings, 529 account. We max our contribution to 401ks for the employer match. We add to supplemental retirement through Roths. Do we continue doing each of the above things, or we better serve focusing on one thing? I think it kind of depends on the interest rate on the car loans and on the student loans. If these are sort of the run-of-the-mill 6%-ish student loans, I'd pay those down first. And if the car loans are more than, say 3 or 4%, same goes there. And I would focus on that. And I would take your foot off the gas on the 529 accounts. I don't think you need to do that. Ideally, what I'd love for you to do is accelerate the debt pay down. The debt gets paid down, and then we can have another conversation about how to put even more money into your retirement account. So check that out. And if you are listening to us right now and you need some help with some decisions, priorities, just send us an email. Ask Jill at JillOnMoney.com. We will be right back with many, many more of your questions. Stand by.
.401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
She covers it all. That's me. Mark, isn't it nice when I come back from vacation, I'm in a cheery mood? You do like that. And I've been getting a lot more sleep, which is fantastic. That said, It is really better to sleep more than anything else. Okay, so few things, little business. You've heard me talk about this throughout the hour, but I'm going to remind you that if you have a specific word or term in the financial lexicon that you would like defined, send us an email. Ask Jill at JillOnMoney.com, because we're building the Jill on Money financial glossary as we speak. So do that. It would be great. And you can always ask us questions. 2 different ways to get in touch with us. Ask Jill at JillOnMoney.com. And then, of course, from the website itself, from the JillOnMoney.com website, just click on the Contact Us button, and you can do that. Mark did that, and he's considering purging several active credit cards that he says he does not use or need. What's the best way to do this without hurting my credit score? By the way, he says he and his wife have credit scores of 830, and they've never paid a dime of credit card interest. That's the same with Mark says that too. My Mark. So here's what I would do. This is what I've been thinking about with these. John Olsheimer, who's a credit expert, he's been on the show many times, says that when you call to cancel the cards, it can hurt your credit score. So what you may want to do is take those credit cards, throw a rubber band around them, and put it in the back of your desk drawer, put it in a lockbox somewhere, and don't use them. And that's it. That's kind of a safe way to do it. You could literally cut them up if you wanted to, but don't actually close the account necessarily. Okay? Here is an email. I love that people are doing this. They're sending me the websites of the people that they've been working with in terms of their firms. He says, I don't see the word fiduciary anywhere. Should I be concerned? So here's what I did. I go to the home page of this person's website, okay? First of all, the funniest thing about this website is here they have like an about. They have living confidently, strategies, and then they have a whole thing for dentists. That must be their subspecialty. They've got resources. Hey, they have a glossary. Let's steal some of their glossary, Mark. Check it out. Client login and contact. Okay, so let's go to the about. Mission statement, useful links. Let's look at useful links. Calculator, stock information. Okay. So they have, I'm not sure they are fiduciaries. They are security. They're sold through, they have some securities business. I don't know if they're registered as investment advisors. So that's, I guess, one thing to ask. You can say, hey, you can just ask them. I know people get really kind of freaked out about that. I mean, you can, they have a link here to the SEC broker check website. That's a possibility. You could just do that. Interested. I sort of feel like, let's look at their team. So they have investment advisor. So the guys are, they're not CFPs. I think these are not fiduciaries. That's my guess. You could ask them. That's one thing to do. But my guess is that they are not fiduciaries. Because and here's like the code words that I look at. This one guy says that he's got strategies including insurance planning, and that to me, once they sell insurance, they have wealth protection planning. Sounds like annuities. So I'm just guessing they're not fiduciaries. I don't know. I'm thinking no. But why not ask them straight up? Wouldn't that be better? I think that's a better way to do it. Nancy writes that, quote, I read your book. It was a straightforward, easy read with clear, concise, informative tips that I shall put to use. Some I've already put in place. Thank you for a wonderful financial literary contribution. Can she put this whole thing right on the Amazon website, please? If you read the book and you like it, give me a review. I don't even know why, but that the publisher says that it works. Anyway, Nancy listens to us on WCCO in the Twin Cities on Saturday evenings. She also loves the conversations with Dave Lee on Mondays. By the way, Dave Lee, all I do in the first part of that conversation, I talk about money, and the last part, a little hockey. And she says that too often the show is preempted by basketball on the weekends. And so, listen, we have nothing to do with that. I'm sorry. If you want, he says, I'm sorry I didn't buy your book. I borrowed it from the library. That's okay. But hey, if I'm a joy to listen to and you like the book, just put the review up on Amazon. That's all I ask, Nancy. Thanks for writing. That was a sweet one. All right. When we return, we're going to talk about phone scams. That's what Sanford wants to worry about this next bit. You're listening to Jill on Money. Hop onto the website where you can please buy the dumb things smart people do with their money. 13 ways to right your financial wrongs. Okay, you can borrow it from the library, but maybe buy it for yourself, for your own library. If you can, that would be great. It's Jill on Money. We'll be right back. You're back with Jill on Money. If you've got a financial question, just send us an email. Ask Jill at jillonmoney.com. Sanford did that, and he said he is a little bit worried about a phone scam. He got a call. It was a recording. He knew it was a scam. He said, I wanted to get more information to report it. I stayed on the phone. It said press 1. No one ever said anything, so I hung up. By pressing 1, could they have tapped into our computer and gotten our personal or financial information or steal our identity? Should we be worried? Because, I mean, basically, I think everyone's worried about that because many people have their phone and cable and internet bundled. I don't think you should be worried. But look, if you are, go on to annualcreditreport.com, flag the report. And if you're really worried, you could probably get someone to poke around your computer to see if there's any viruses on there. Okay? James is planning to retire in 2024, which is the year before the current tax rate cuts expire. So in 2025, I plan to have enough cash on hand to support what we need to live on that year. Since I am convinced that tax rates are going to increase big time after 2025, I'm thinking of converting my $315,000 IRA to a Roth and pay the 24% tax. My Roth is for long-term growth, blah, blah, blah. Do I think this is a good idea? Yeah. I mean, I love the idea of converting. I guess what you're thinking is you do it all in 2025. I can't remember when the rate changes. Is it 16 or 26 or 25? But yeah, I mean, if you can do this, that would be great. And I think that that's a great way to lock in what your tax liability is going to be. Look, you got time, right? So I wouldn't go crazy. That sounds like a darn good idea. And everyone should be thinking the same way, which is, how do I lock in these lower rates? Last but not least, Bob wants to know how to borrow money. He needs about $30,000 to buy not just first rental property, not the second, but his third rental property. And he says home equity, some other loan. He says, I assume I shouldn't borrow from my 403B. No, do not borrow from your 403B. Yes, you can get a mortgage. Go check out which one makes the most sense for you, whether on one of the rentals or maybe another. Okay, that's it. That's all for the program. You have been listening to Jill on Money live from the Policy Genius studios. Go check out Policy Genius. It's the easy way to compare and buy insurance. And check out our website, jillonmoney.com. There you can find all this great content, and also you can sign up for our free newsletter. Free, and it's weekly. It's fantastic. All right, thanks for listening. We'll see you next week.